Welcome to the latest in a series of conversations with Witan's investment managers. My name is James Hart. I'm investment director of Witan Investment Trust, and I'm joined by James Bullock, portfolio manager at Lindsell Train Limited. Lindsell Train is one of Witan's longest standing managers, having run money for us for over a decade, and they currently are responsible for about 16% of Witan's assets managed in a global equity portfolio. James, welcome.
Hi, James. Thank you. Nice to be here.
Can you start by introducing Lindsell Train and explaining your investment approach and giving our shareholders an idea of what your role is within the Lindsell Train team?
Of course. So I've been with Lindsell Train for give or take the last 10, 11 years, and I am currently a co-portfolio manager on our global strategy. And essentially that strategy is looking to analyze and to buy very high quality companies that we can see have already and we think will go on to prove resilient and durable. So we want to own businesses that have moats that are there protecting high underlying rates of return. We want to own them for long enough to benefit from the consistent compounding that implies. And yeah, we're building concentrated portfolios of these great but rare businesses and aiming to hang on to them for very long periods of time.
Well, this conversation is taking place in October 2022, when perhaps the durability that you talk about is more relevant than in most investment periods. The economic environment is extremely volatile at the moment, and equity markets have performed poorly so far this year. Indeed, many world markets are down over 20% in local currency terms, and that includes the US market, which has obviously been one of the leading performers over many years. James, can you explain what has been driving these equity returns, these poor returns for equities so far this year, and which sorts of companies have suffered in particular?
No, well, I mean, it's always tricky to speculate, but I think inflation is a very important backdrop to all of this. And the reality is that if you don't beat inflation, then over time you will compound, but compound in the wrong direction. And plenty of people, Warren Buffett and others, have likened that to a tax on earnings. And if you think about it, if you're running a 5% return on your investments, but inflation is running at 6%, say, then you're effectively giving up more than 100% of your income. And I think the response is that a lot of common valuation models will use interest rates as a direct input. So if you raise the rate in your denominator, then correspondingly the implied valuation of your business is going to fall. And if you follow that line of thinking, then you might argue that the slightly more speculative, the people call them long duration stocks, where the value of the companies are heavily reliant on the expectation of distant future earnings, they are going to be harder hit. I suppose in sympathy with that view, you've got things like the NASDAQ, which is down, at least in US dollar terms, about 30% year to date. Having said all of that, though, markets are chaotic and complex, and guessing the motives and mechanisms behind it all, it can be a bit dangerous. But I think that is an important control.
Absolutely true, and lots of investors will have experienced some of the falls that you've been talking about. With inflation running so hot and interest rates rising, many commentators are suggesting that real assets such as gold or property are the places to hide in such an environment. Does that mean it's a bad environment to invest in equities in an inflationary environment, or are there some parts of the equity market that offer good returns irrespective of the inflationary forces around us?
I would certainly have sympathy with the latter argument there, and you might even argue the case for equities in general. I mean, I can well understand the desire to own real assets in an inflationary period, which it seems like we're in. But I think the reality is, if your time horizon is long enough, then equities actually do a pretty good job of looking like real assets as well. So, always remember that owning shares in a company gives you a direct claim on that underlying business itself. And the business may well be impacted by inflation, and some more than others. But in general, if you have a company that is selling real products, charging real prices for it, then they're going to be earning real cash flows as a result. And you, as an owner of that business, is going to be looking at real returns in general.
I think it's probably fair to say that Lindsell Train look to own companies for longer than most investors. So time is certainly on your side in that respect. Um, you say you look to invest in exceptional companies, often with long histories and strong brands. At least, and I think I'm right in saying that the average age for the companies within your portfolio is roughly 120 years. So a long track record for over which to judge those returns. Can you give us an example of how such companies have helped protect shareholder purchasing power over the long run, and how they might indeed be able to do so in the current environment?
Yeah, well, having said those nice things about equities in general, I think the reality is that some businesses will certainly do this job better than others and preserve purchasing power better than others. And it ultimately comes down to pricing power for most companies. So the more of that you have, the easier you're going to find it to pass on any cost inflation without complaint from your own customers. And I think a big part of our investment process is to seek out these companies. So to find those with the really strong brands, those with the long history of building those brands, of evidencing their strength. And one of the holdings we really like to kind of reference in that regard is PepsiCo, which follows the mold of longevity that you just referenced across our portfolio. I mean, they've been building their brands for the past 130 years, and it's actually quite a nice data trove as well. So we've got some nice historic figures on PepsiCo, on their struggles and successes with inflation. And we managed to go back to the mid 60s and showed that whilst inflation over that period has had a frankly debilitating effect, so the dollar is devalued by a factor of around 8. But in response to that, the pricing power of Pepsi's brands, so let's say a bottle of Pepsi Cola, the price of that has risen more than 20-fold. So they are clearly pricing well ahead of inflation. They're protecting purchasing power for the company in doing so, and for the owners, the shareholders in the business. And basically, if you then add in M&A, volume growth, all the things that a successful business is doing, the revenues have grown roughly 150-fold over that time horizon in nominal terms. And the share price, or the total return from the shares over the last 40 years, has compounded at nearly 15% per annum. So, obviously no guarantees for the future, but at least in a backward-looking sense, super long-term shareholders have seen a pretty handsome, certainly inflation-beating rate of return.
Certainly have been, and as my 9-year-old would attest, the power of the Pepsi brand is certainly alive and kicking. Well, these are clearly turbulent times, James, but it is worth remembering that Witan, and indeed many of the companies in your portfolio, have been around for well over 100 years and weathered many storms. So we're optimistic, but by no means complacent, that a portfolio of well-managed, sustainable businesses with enduring cash flows should continue to deliver attractive real returns for investors over the long run. Thank you very much for joining us and sharing your thoughts on this fascinating and indeed highly relevant subject today, James.
Great. Thank you, James.
Thank you.